Common Sense on Mutual Funds, New Imperatives for the Intelligent Investor by John Bogle, is a landmark book that offers a deep dive into the world of mutual funds, providing both novice and seasoned investors with essential insights and guidance. Written by the founder of Vanguard Group and the creator of the first index mutual fund, Bogle's work is a comprehensive exploration of mutual funds and a powerful advocacy for the principles of low-cost, long-term investing. Introduction: the Bogle philosophy. Jack Bogle's investment philosophy, often referred to as Bogleism, is built on the principles of simplicity, low costs, and long-term focus. He emphasizes that the most effective investment strategies are not necessarily the most complex, but rather those that minimize costs, reduce risks, and are easy to understand and implement. This philosophy is rooted in Bogle's belief in the efficiency of markets and the difficulty, if not impossibility, of consistently outperforming the market through active management. Bogle begins his book by addressing the fundamental problems with the mutual fund industry, including high fees, excessive turnover, and a focus on short-term performance. He argues that these issues ultimately detract from the returns investors can achieve, and that they are often overlooked or misunderstood by the average investor. His solution is straightforward: invest in low-cost index funds that track the overall market, avoid trying to time the market or pick individual stocks, and stay the course over the long term. Part II on investment strategy. In the first part of the book, Bogle lays out the case for index investing as the superior investment strategy for most investors. He begins by explaining the concept of the relentless rules of humble arithmetic, which asserts that the gross returns generated by the stock market are reduced by the costs of investing, such as management fees, transaction costs, and taxes. These costs, while seemingly small, can have a significant impact on net returns over time. Bogle argues that actively managed mutual funds, which attempt to outperform the market through stock selection and market timing, are at a significant disadvantage due to these costs. He provides evidence showing that the vast majority of actively managed funds fail to outperform their benchmarks over the long term. This failure is largely due to the high fees and expenses associated with active management, as well as the difficulty of consistently picking winning stocks or timing the market correctly. In contrast, Bogle advocates for index funds, which simply aim to replicate the performance of a broad market index, such as the S&P 500. Index funds have significantly lower costs because they do not require the same level of research, trading, or management as actively managed funds. Over time, these lower costs translate into higher net returns for investors. Bogle emphasizes that while index funds may not outperform the market, they are guaranteed to match the market's performance, minus minimal fees, making them an ideal choice for long-term investors. Bogle also discusses asset allocation, which he identifies as one of the most critical decisions an investor can make. He argues that a diversified portfolio, spread across different asset classes such as stocks, bonds, and cash, can help manage risk while providing the potential for long-term growth. The appropriate asset allocation depends on an investor's age, financial goals, risk tolerance, and time horizon. Bogle suggests a simple rule of thumb: allocate a percentage of your portfolio to bonds roughly equal to your age, with the remainder invested in stocks. Part II on investment performance. In this section, Bogle examines the performance of mutual funds over time, offering a detailed analysis of why most actively managed funds fail to outperform the market. He presents data showing that, on average, actively managed funds lag behind their benchmarks, particularly after accounting for fees and expenses. Bogle also highlights the impact of taxes on investment returns, noting that the frequent trading and turnover typical of actively managed funds can lead to higher capital gains taxes, further eroding returns. Bogle discusses the concept of reversion to the mean, which suggests that funds with exceptional performance in one period are likely to see their performance decline in subsequent periods. This phenomenon is often driven by the fact that fund managers who achieve high returns in one period may take on excessive risk or benefit from temporary market conditions that are unlikely to persist. As a result, investors who chase past performance by investing in hot funds often end up disappointed when those funds fail to sustain their success. Bogle also critiques the mutual fund industry's marketing practices, particularly the emphasis on short-term performance and the use of past returns as a selling point. He argues that this focus on short-term results encourages investors to make impulsive decisions, such as switching funds frequently or attempting to time the market, which can ultimately harm their long-term returns. Bogle stresses the importance of maintaining a long-term perspective and resisting the temptation to chase short-term gains. Part I on mutual fund selection. In the third part of the book, Bogle provides practical advice on how to select mutual funds. He reiterates his strong preference for low-cost index funds, arguing that they offer the best combination of simplicity, low fees, and reliable performance. For investors who prefer to include actively managed funds in their portfolios, Bogle offers several criteria to consider, including low expense ratios, a long-term track record of consistent performance, and a fund manager with a significant personal investment in the fund. Bogle cautions against over-diversification, which he refers to as diversification. While diversification is essential for managing risk, he argues that holding too many funds, particularly if they have overlapping investment strategies, can dilute the benefits of diversification and lead to suboptimal performance. Instead, he suggests that investors focus on building a portfolio of a few well-chosen funds that cover a broad range of asset classes. Bogle also addresses the importance of maintaining discipline and sticking to an investment plan, even during periods of market volatility. He emphasizes that the most successful investors are those who remain patient, avoid making impulsive decisions, and stay the course regardless of short-term market fluctuations. He warns against the dangers of market timing, noting that even professional investors struggle to consistently predict market movements, and that attempts to time the market often result in lower returns. Part IV on future returns. In the final part of the book, Bogle discusses the future of mutual funds and the likely returns that investors can expect going forward. He is cautious in his outlook, noting that historical returns may not be indicative of future performance, particularly given the changing economic landscape and the potential for lower economic growth and interest rates in the future. Bogle emphasizes the importance of setting realistic expectations for investment returns, particularly in light of the low interest rate environment that has persisted in recent years. He suggests that investors should prepare for more modest returns than those seen in the past, particularly for bonds and other fixed-income investment. However, he remains optimistic about the long-term prospects for equity investments, particularly for those who invest in low-cost index funds and maintain a disciplined, long-term approach. Bogle also discusses the ongoing evolution of the mutual fund industry, particularly the rise of exchange-traded funds, ETFs, and other low-cost investment products. While he is generally supportive of ETFs, particularly those that track broad market indexes, he cautions investors to be wary of more complex or narrowly focused ETFs, which may carry higher risks and costs. Conclusion. Common Sense on Mutual Funds is a powerful and persuasive book that offers invaluable insights for investors at all levels of experience. John C. Bogle's emphasis on low costs, simplicity, and long-term focus provides a clear and compelling roadmap for achieving financial success through mutual fund investing. Bogle's advocacy for index funds, in particular, has had a profound impact on the investment industry, leading to the widespread adoption of low-cost, passively managed investment products. His arguments are supported by decades of data and research, and his practical advice is both accessible and actionable. For anyone looking to build a successful investment portfolio, Common Sense on Mutual Funds is an essential read. Bogle's timeless wisdom and common sense approach to investing provide a solid foundation for making informed decisions and achieving long-term financial security. Whether you are a seasoned investor or just starting on your financial journey, this book offers the guidance and perspective needed to navigate the complex world of mutual funds with confidence and clarity.